With us this morning, we have Dominic Calabro, who is president and CEO of Florida Tax Watch. Dominic has led Tax Watch for over 40 years and serves as a member of our Florida Press Association Board of Directors. Dominic has been appointed to serve on task forces and study groups by every governor going back to Bob Graham. Now I'm telling your age, Dominic. Also with us this morning, we have Senior Vice President of Research at Florida Tax Watch, Kurt Wenner. Kurt is one of Florida's leading tax and local tax analysts and has 4 decades of professional experiences with taxes. So without further ado, I'm going to turn it over to Dominic. Dominic, take it away.
Thank you, Jim, and Karen, and Glenn as chairman, and Sam as well. Florida Tax Watch is very honored to help illuminate the process of property taxation and knowing the difference, how our Truth-in Millage laws work. We have some of the best tax laws, but they only work to the extent that the reporters and journalists report on them accurately and pursuant to state law. So without further ado, again, as Jim, as you said, we have the very fortunate to have had a very good working relationship with journalists through, again, 4 decades, 40 years. Between Kurt Wenner and myself, we have nearly 8 decades of experience. Now that either means we really know what the hell we're talking about or just over the hill. So either way, I'm going to defer a lot to Kurt Wenner because he really is one of the preeminent, not just scholars, but experts that can not only tell you what it is, but help you understand what it means. So Florida property taxes are very, very important to understand. And again, as the eyes and ears of the taxpayers for these 40 years, we hope this presentation will illuminate. One thing I want to mention as we go forward, for each different section that we have, where you've asked that you have your chat comments into Jim and Sam and Karen, then they'll share them with us so we could address the questions during each of the presentations. So it's more dynamic, more engaging. It's also more on time, more real-time interaction. And then after we've finished some of those, if you still have, and you may very well, hopefully you'll have a lot more questions that other questions will lead to, we can be interactive in those, and I rely on Jim to help facilitate that process. So real quick primer, Florida's property taxes raises $36 billion for cities, counties, school districts, and special taxing districts. It's levied on real and tangible personal property taxes. It's assessed at just or fair market value as of January 1 of each year, particularly for residential. By Constitution, residential taxation, property taxes must be in the Constitution assessed on the value of January 1. That's also been true historically with what we had once before. Another property tax that I'm glad Tax Watch helped lead in the phase out of was the intangible personal property tax. But anyway, fair market value, just market, is the value of what a arm's length transaction between a willing buyer, a willing seller, over a reasonable period of time without undue influence, like you gotta sell or you're under great pressure, and can get what is close to the market value. So the market value is determined by replacement costs, construction costs, or in many cases for commercial properties, a multiple of the rental value on that. The Constitution of Florida prohibits the state property tax, except for a tax on intangible personal property. It's authorized in the Constitution, but it's been phased out statutorily. That is different, though. Property taxes, it has an outright prohibition in the state constitution. You've heard that the personal income tax or a state inheritance tax or state gift tax, it's not actually prohibited. It's authorized, but very extraordinarily restricted. It's restricted to the extent to which the federal government or another state provides a dollar-for-dollar tax credit against what a Floridian would pay. Since that's not the case, it's tantamount to a prohibition, but actually the only tax that's prohibited in our state constitution is a state property tax. Jurisdictions, cities, counties, school districts, special districts are limited to 10 mills, with some exceptions for voter-approved levies. And the Constitution strictly limits new exemptions and adjustments to fair market value. You could see, I guess, in the next, the growth in property tax levies. And I'm going to leave this to turn it over to Kurt Wenner, our Senior VP for Research and Tax Policy. Kurt?
Thank you, Dominic, and thank you all for inviting us to come talk to you. As Dominic said, the property tax brings in about $36 billion. It's the largest tax source in Florida among state and local governments. It passed the sales tax a few years back and now brings in more money than any other source. And as you can see, it's grown pretty significantly from about 12.9 billion back right before the 2000 and is all the way up to almost 36 billion. And you can see the dip that happened where it got down to a low of 24, and that was after the housing bubble burst and we came out of the Great Recession. One thing about recessions, and I think we're going to see it to some degree on this one, is property tax revenues are hurt a little slower than, say, state revenues. Sales tax are hurt right away, but the way property taxes are levied and collected, they're really not collected till more than a year after they're assessed on January 1. So I think that we will start seeing some problems with property taxes if, in fact, home values end up being significantly, property values in general end up being significantly impacted. But that is really the only time that property tax revenue has fallen in the state of Florida. And as you can see now, it's back on the rise. We'll go to the next one, please. This is who levies the $36 billion by jurisdiction. So you can see about 40% of the average Floridian's tax bill is made up of school taxes. The next biggest is counties and cities. Special districts are a relatively small portion. These are independent districts. The dependent taxing districts would be included in the county levies. We'll go to the next one, please. This is who pays it as property types. The biggest one is non-homestead residential. That's second homes, rental property, things that don't qualify for the homestead exemption. Real close to that is homestead at 33%, homestead exemption residential. And then 25% is non-residential businesses and everything that's not residential, and large, say, apartment complexes with multiple units are considered non-residential. So when you add in the tangible personal property tax, which we'll discuss briefly in a minute, it's roughly about one-third between homesteaded property, non-homestead, and then, business or commercial property. So move on to the next one. As I said, tangible personal property is also subject to property taxes. It's taxed at the same rate that your property is in whatever jurisdiction you're in. Household goods and vehicles are exempt, so the tax is just paid by businesses on their machinery, equipment, furniture, computers, and the like. It brings in $2.5 billion, which is a relatively small portion of taxes in Florida. As you can see, it's about 6.5% of the tax roll in Florida. But in some counties, the smaller rural counties, TPP can make up more than half of a tax base for a rural county. Conversely, the largest counties in the state, it only makes up 5%. So it's not that big of an issue financially in urban counties, but when you get down to rural, it becomes a big issue. So move on, please. And this just briefly shows you where property taxes are in terms of city and county's total revenue. Actually, property taxes have been declining even before we had the revenue fall after the Great Recession. As a as importance in the total revenue picture. As you can see, the big one here, charges for services, is what's been growing the fastest. And, you know, that's a way to charge for things, basically avoid having to increase property taxes. So local governments have looked for ways to bring in revenue without having to adjust property taxes, which obviously doesn't make people happy. But it still makes up a significant part. And if you look strictly at the general budget of a local government, it has more of a more importance. So move on. Millage rates. The millage rate is the tax rate for property taxes, and 1 mil is a $1 in tax per 1,000 of property tax value. So if you have a 10 mil property tax levy, that's 1%. And 1 mil is worth $2.3 billion statewide, and that's on school taxable value. Now, school taxable value is higher than county taxable value because some of the exemptions that have been passed in recent years, such as the non-homestead cap and some of the homestead exemptions, don't apply to school taxes. So most of the tax breaks that the legislature has given through the Constitution, because as Dominic mentioned earlier, just about anything you want to do to property taxes needs to be done through the Constitution. So that's a little bit higher. The average millage rate in Florida is 17.32 mils. And I believe there's a graph a couple slides down that we'll get to about those growth. So if you could move to the next one, please. Millage rates are for all jurisdictions are capped at 10 mils, although you can, there are certain levies that you can vote on to get you over 10. Dependent special districts are included in the limit for the government in which they depend. So all the dependent special districts of a county are included in their 10 mil cap. Independent special district rates are limited by whatever law established such districts. 10 mils can be exceeded by a referendum, as we mentioned. And counties providing municipal services can levy up to an additional 10 mils in areas that, unincorporated areas that receive such services. That's the MSTUs. So move on, please, to this slide. Yeah, here shows the growth in millage rates. And as you can see, millage rates have actually been going down. They started to rise in the Great Recession as local governments tried to make up some of the lost revenue. But and we'll talk about this when we get into trim and setting millage rates, when property values are increasing rapidly, you generally see a reduction in the millage rate. It's not proportional, but it still happens. Now, in 2020, which is not on this, the millage rate for the first time in some time actually went up. So instead of falling in 2020, the millage rate, which is now 17.27, rose from the previous year. Next slide. The rollback rate, which you have probably heard about. The rollback rate is the millage rate, which when you apply it to the current tax roll, provides the same property tax revenue for taxing authority as it did in the previous year. New construction and additions and new annexations and property tax that's deleted from the rolls are excluded from the calculation. This provides some growth revenue, and basically new construction averages about 3% growth. So that's what local governments get if they adopt the rollback rate in terms of growth. Any proposed millage rate in excess of the rollback rate is considered a tax increase and requires a notice of proposed tax increase. And Dominic's going to talk about that in just a minute. But the public can attend a hearing to provide input on the proposed tax increase. So there's been a lot of discussion about what is a property tax increase, but according to the statutes, anything that goes over the rollback rate is one because of the advertisement. So, you know, we've seen that debate in the legislature recently with the required local effort school taxes, which the legislature sets in the budget every year. They decide what the split of funding for the FEFP education funding formula, the split between local and state contributions are. But they had been called, you know, a lot of times you'll see here a local government keep the same millage rate and say we're not raising taxes, when in fact they are if the rollback rate was less. You know, I think Dominic might talk about this too. One of the surveys that we did of local governments about whether or not they feel like they raise taxes. You know, during the housing bubble, when property tax revenue was increasing so quickly, property tax values, local governments were actually able to reduce property taxes millage rates pretty significantly and still bring in substantial new money. And they would say that they were cutting taxes when in fact, according to the law, they were not. Which if you
This is a good time, if I can, Kurt, let me just step in for just a second. Kurt's absolutely right. And let me give you an example between a property tax rate increase and a property tax increase. They are related, but very different. Because valuation countywide or citywide can rise dramatically during the period from 2000 to about 2007-8, we saw levies rise 25%, in some cases 30%. That was excluding new construction, okay? So if you were taxing at value of $100 million, all of a sudden that same rate, the same millage rate would then generate $130 million, okay? So even though you reduce the millage rate, whatever it was, a little bit, unless you reduce enough to offset that extra $30 million, that's what the truth-in millage is. What would it take, millage rate, to get the same $100 million on a higher valuation, excluding improvements to property, new construction, any new malls, developments, any new construction, okay? So you can actually have a decrease in the property tax rate and still have a true legally defined property tax increase. And that's often confusing. And obviously people trying to justify a tax increase to make it easier to distribute benefits with the tax dollars, other people's money, either unknowingly or knowingly misstate that. That's one of the key points that I think is really important with the Truth-in Millage notice that I really want to get across to writers, reporters, journalists, so you really understand that. The rollback rate is designed to roll the millage rate back to collect the same amount of money as you did the prior year. And anything over that millage rate, even if you rolled the millage rate back, you didn't roll it back enough to get the same $100 million in that case. Anything more than that would be a property tax increase, though the millage rate was reduced. So that's very important as part of the Truth-in Millage, because property taxes are determined by the value of the property, excluding the new construction, times or multiplied by the millage rate, or $1 per $1,000 of taxable value. Exempt properties like Saver Homes, governmental properties, these kind of things they reduce the taxable value of all the properties in each county, city, and jurisdiction. So that's really important. Now, the other thing I really want to mention, and this is an important role that I think journalists and reporters play, but also it's a key role, I think, of the free press and newspapers in our state. The Truth-in Millage is required legal notice that has to be published in newspapers of record. There's a competitive process by which that is done. The beauty of that is, among other things, is it makes it harder for people, particularly the taxing authority. By the taxing authority, I'm not talking about the property appraiser. Absolutely, she or he is not the taxing authority. It's the county government, it's the city government, it's the school board or the special district. They are the taxing authority. They have the responsibility to reduce the millage rate and show that, and oftentimes it's not properly understood. But by having the newspaper advertisements published in newspapers of record, it pushes the information out. So viewers don't have to go to a website that may or may not describe it properly. Oftentimes we have found through, my own experience, some 40 years, Kurt's almost 40, it's like 80 years together, we've seen many cases where there's a misnomer, misunderstanding of what they say, and even sometimes what they send out in materials. But what they put in the newspaper advertisement is absolutely the legal requirement in compliance with law. And that's why Florida Tax Watch has been such a big proponent of keeping newspapers of record, having some of that information published and being pushed out there. Fortunately, under the law, there's also ways that that information is also provided online, but it's provided by a neutral third party, not the taxing authority themselves, that gives the kind of independence. That's really, really critical. We have seen examples time and time again where I've actually gone before the county commission in South Florida, and John Turcott, who's very well respected, former director of the legislative office of Opaga, went down there and they tried to say in Palm Beach County that this is a property tax reduction. And according to the Department of Revenue and trim notice and publicly required notice, it showed nope. It's kind of like, were you lying then or are you lying now? I mean, so the key is really important, and it's often going to be misunderstood. Why is that important? It's always important. But because there's going to be such a demand to provide revenues, we don't mind them talking about it accurately. If they've got to raise tax rates, that's fine. Just be honest, transparent, and correct about what they're doing. So it's really important in this next year, between now and September 30th, that there's going to be a lot of pressure on taxing authorities to either blame the property appraiser, which it's not his or her fault. They're supposed to just report, and if they're out of line, then there's checks and balances on that. But it's really important because they're going to try to find more revenue without having to do the heavy lifting of increasing the property tax or millage rates. So that's very, very important. Kurt, continue if you would.
Okay, before we move on, I just want to mention that rollback rate can work the other way. If a jurisdiction has a lower tax roll than it had the time before, the rollback rate can actually become a roll forward, where the rollback rate would be higher than the millage rate that they were levying in the prior year. And that, according to law, is not a tax increase. Just because the rate went up, is still the roll back or roll forward rate. So it is actually not a tax increase. Karen, could you go back one slide? 12, thank you. We'll get into the Truth-in Millage, which is how where the rollback rate comes into play and how millage rates are established. The trim notice is a very good taxpayer safeguard that compares last year's taxes with the proposed taxes for the coming year, as well as taxes if no budget change is made, and that's the rollback rate. It also provides notice of public budget hearing to adopt the proposed budget and the millage rate. Next slide.
Kurt, real quick, Dominic talked a little bit about the timing, and in the spirit of educating readers about the process, could you highlight a little more about when is a good time to get this information out? In one of the slides, you talked about hearings. Could you talk a little bit about that as well?
Yeah, as a matter of fact, the very next slide, I think, goes into, shows the trim calendar, and we can
Okay.
talk about that there.
Perfect. Thank you.
The trim notice,
Good question, Jim.
yeah, the trim notice contains last year's taxable values for, and it lists all taxing authorities, all school, city, if you happen to be in the municipality, county, and the special districts. It has last year's millage rate and the property taxes levied by each authority, the current year taxable value, and then the tax rate and corresponding taxes by each authority if no budget change is made. This is the rollback rate. So basically what the trim notice does is it lets taxpayers say, okay, this is what's going to happen if the proposed budget is adopted. My local government wants to spend more money. That's going to require a higher millage rate, and they can see what that actual effect is going to be on their tax bill. It's a very good taxpayer safeguard, and Florida Tax Watch has been very protective of it over the years. So let's move into the next one. We can get into the timeline a little bit. Oh, this is more of what the trim notice contains. It's got the Save Our Homes assessment, which we're going to talk about in a little bit, which is a real important feature of Florida's tax system. It also has non-ad valorem assessments levied on the property. And for those of you that don't know, a non-ad valorem assessment is charged against the property, but it's not a property tax based on value. It's a property based on some way to tie it to whatever the service is that's being provided. It can be, the frontage of the property. It can be the cost of the service, say, garbage pickup or sewer or whatever the non-ad valorem assessment would be, divided among the people that are going to pay it. And that's another thing that we've been seeing more and more of over the years, as it's a way to, again, not actually raise property taxes. Move on to the next one. The trim calendar. Now, the trim calendar assumes that the property appraiser will certify the value to all the taxing authorities by July 1st. That doesn't always happen, but the calendar is based on how many days after the previous step. And so it's not always the same day, but we have days here assuming it's a July 1st start date. Budget workshops are already starting to be conducted at the local area, starting to figure out what they want to propose. Then on August 4th, or 35 days after the roll is certified, the officials advise the property appraiser of what their proposed millage is, what these budget workshops have come up with of how much money they want to fund whatever budget they want. It has the rollback rate and the date, time, and place of the tentative budget hearing. So that's the first step in approving the local government's next budget. Then 55 days later, which is right about now, the property appraiser mails the notice of proposed property taxes, which is commonly referred to as a trim notice. That is mailed out to taxpayers, and it tells them when the tentative budget and millage hearing would be, and taxpayers can examine what their property tax increase would be. So property taxes are going to be big on people's minds right now. This is when people are going to start seeing those trim notices, and hopefully people will start coming to budget hearings and speaking their minds. Then after that, 65 to 80 days, usually the first part of September, is the tentative budget and millage hearing. This is where the tentative budget and millage are adopted. If they're adopting a higher than the rollback rate, they have to then put in the notice of proposed property tax increase. Or if they're not, they just have to do an advertisement that tells when the final budget and millage hearing is. And that takes place in October early October, 100 days after the tax roll was certified, and that is the final budget and millage hearing, and they vote on that there. So this is how the trim notice works. We're right square in the middle of the process right now. Local governments have pretty much decided what they want to do. They're going to be notifying taxpayers now, and then the taxpayers will let them know if they agree. Is there any questions about that before we move on? As Jim had mentioned it. Is that the information you were looking for, Jim?
Yes,
Okay,
thank
good.
you. Yeah.
All right, let's move on. There is another millage limitation in law. This is in statute, and this is one of the few areas where you can affect property taxes by statute. During the quote property tax crisis back when the housing bubble was going on, and one thing I want to say about that, I don't know how many of you were around then or remember it, but there was a lot of talk about this property tax crisis. But what it really was because of Save Our Homes, the taxes were going up significantly on everything that was non-homestead. But for people with Save Our Homes, it wasn't increasing at all. So the legislature got in and tried to make some changes, but what they wanted to do was give more breaks to homesteaded property and weren't really addressing the problem. So one thing that they did was they came in with this these millage caps, and at first it was going to be based on they mandated how much local governments had to reduce their millage rates, and that was based on how their millage rates have grown in the last few years. So the more you would increase taxes, the more they were going to mandate that you roll back your rate. The millage cap could be overridden with a supermajority of vote, and in that year, almost more than 1/4 of local governments did override that cap with a supermajority vote, and that was effective until 2009, and then after that, they put in a limit that local governments be limited to the rollback rate adjusted for personal income growth. So the rollback rate, which already provides a little bit of growth from new construction, would also be adjusted for the growth in personal income. And that would be, it didn't change what the rollback rate was, but it changed what the limit for local governments could pass with a majority vote. So they could go up to that amount, which was a little bit over the rollback rate and was still a little bit of a tax increase. And they could approve that with the normal majority vote. The governing board could exceed that cap by as much as 10% with a 2/3 vote. And then they could go over that to anything that they wanted if they could get a unanimous vote. And the Department of Revenue looks at the compliance to this law every year and publishes the results. And last year, almost 1 in 5 local governments overrode the cap, 121 of them, including 12 with the unanimous vote. Another thing that needs to be mentioned here is in a lot of situations, this limitation has become fairly meaningless because it's based on growth from what the maximum amount of they could have levied was, not what they actually levied. So you have some local governments that actually have a huge cushion, amount between what they're levying now and what they could levy with a majority vote. Some which are well in excess of what the cap is. So for a lot of local governments, there is not really an effective millage limitation anymore. There's even one, I think the West Palm Beach Downtown Development Authority, and I checked to see if they were right, and I still don't understand how the math could work, but they could raise their their millage rate to, I forget the number, but billions of mills, and still be able to do that with a majority vote. I guess the levy that they had was very, very small, and then they increased it pretty significantly, and that how that led to that. But so that's the millage limitation that is in law right now. Moving on. Now, after the trim, after you get your trim notice, you can contest your property tax assessment. There are three ways to do that. First, at any time, you can ask your property appraiser for a informal meeting where you go in and speak to them or his staff or her staff and try to work out the disagreement on your own. If that doesn't work, the next step is to petition the Value Adjustment Board, which we'll discuss in just a minute. And if you're still not happy, you can go to circuit court. Let's move to the next one. Now here's the Value Adjustment Boards. You know, each county has a VAB, which you can not only contest assessments, but also denials of exemptions. Like if they say you don't qualify for the homestead exemption, you think you do, or portability of Save Our Homes, you can challenge that as well. There's usually 5 members, 2 county commissioners, a school board member, and 2 citizens. Many counties use what they call special magistrates to conduct hearings and recommend decisions to the VAB, but the VAB will make all the final decisions. You can represent yourself or use a friend or family member or an attorney, CPA. There's a small petition fee of $15. And if you have a pending appeal, you must pay 75% of your tax bill and all non-ad valorem assessments by March 31st, or the VAB must deny that petition. So you're still going to pay even while they're trying to work out the ruling. The next one. Here's the calendar. After the trim notice goes out, during September and August, taxpayers can request that informal conference. So those are probably going on now or soon. Usually after the trim, when the trim notice comes out. So then in September, they must file a petition with the VAB by the 25th day after the trim notice was mailed. Then before the hearing, 25 days, the VAB must notify the petitioner of the time of the appearance, and it can be rescheduled. Each side can reschedule at one time for good cause. Move on to the next. This is more about, you know, when you have to give evidence and things like that. But the taxpayer or the appraiser or the collector can appeal a VAB decision about homestead or tax deferral to the circuit court. And then within 60 days after the decision, the taxpayer or the appraiser can appeal a VAB decision about the value they put on your property and the denial of portability. And then 20 days after the last day the board is in session, the VAB issues a written decision and sends the decision to the petitioner. Moving on. I did want to talk about Save Our Homes, which I'm sure most of you are familiar with, but I want to tell you a little bit about how it actually impacts Florida's property tax system. This Save Our Homes limits homestead assessments, that's people that have a homestead exemption, their growth to 3% or inflation, whichever is less. It's been much less recently, between 1% and 2% usually. So the assessment of most homesteads in Florida has not risen much. Change of ownership results in the loss of Save Our Homes. If you buy someone's house, you can lose that, but there is portability, and you can take your savings to another house as long as you do it in a certain time period, which the legislature has been trying to increase in the last couple of years, and move it on to the new house. That was something that was added after Save Our Homes first came into existence. And there's also a recapture rule with taxpayers do not like, and it says that your assessment may go up by the Save Our Homes cap, even if your market value goes down. Now, it can't go above what the just value is, but say you have, your home is already assessed at $25,000 below what the just value is due to Save Our Homes, and your value actually falls, your assessment is going to go up by the Save Our Homes cap or inflation, whichever is lower, even though you had a reduction. That's another thing that requires a constitutional amendment, and the legislature has talked about it for years. It hasn't been much of an issue lately with property values on the rise again, but that's something that has caused a lot of consternation for homeowners when they get their bill and say, that their actual value fell and then their tax went up. So move on to the next one. Now, people have often described the property tax system as a balloon, and if you squeeze one part to lower the taxes, the rest of it's going to get bigger. And that's generally what tax relief does in property taxes if it's not comprehensive or widespread. And this shows the Save Our Home differential, which is the difference between the just value of homestead property and the taxable value of homestead property. And you can see how it grew significantly during the housing bubble to $422 billion of taxable value. That was the difference between taxable value and just value. Now, if you remember, property taxes grew faster than ever during that period. Although homestead property that was under Save Our Homes, the average value during the bubble actually fell, the amount of your property taxes. So what happened to that $422 billion of taxable value and the property taxes it would raise? That was shifted to non-homestead property, because they would see their values go up, whatever their just value went up, and it put up, the Save Our Homes differential would put upward pressure on the millage rates. So that's why we had so many people that owned non-homestead property complaining about their taxes back then, is because their taxes were growing even faster than their values were rising. Then
Hey, Kurt, can I step in for a second?
Sure.
Kurt? Yeah, just right here, just looking at, say, the 422 billion of taxable value in 2007, assuming that you had 17 mills, which is 1.7%, you can see that's about almost, well, close to $6 billion of taxes. Okay, now go to 2020, 308 billion, again on 17 mills, a millage rate of 17 mills, which is equivalent to 1.7%. So you could see that you're looking at $3 to $5 billion on top of the $36 billion that's already collected. So they would be higher by a gross margin of 10 to 12%, but for the Save Our Homes differential. What it does is just shifts it to residences that do not have Save Our Homes, that are not some residential properties like second homes, foreign nationals, and also all commercial renters and commercial properties. So just so you get an understanding of how the impact of that Save Our Homes has. Initially very little back in 1995, and it grew to almost $500 billion of taxable value. In 2007, it fell down because of the Great Recession, and it began to build up, and it's continuing to rise because residential property, even during the pandemic, is growing faster than other components of the economy. So just have appreciation for that. And it's, as Kurt said, it's pressing the balloon. When you press one end, the other end that's not being pressed expands, and that's commercial properties, small property owners and the like, who really getting squeezed out, and particularly during this pandemic, are getting really, really impacted far more than residential property owners. Thanks, Kurt.
Yeah, yeah, as you can see in the drop in it, that's because of that recapture rule we talked about earlier, that that the non-homestead property, or all the property that wasn't under saver homes, their property would be able to fall as their actual values fell. But the homestead property would still be going up by a small amount, but it would still be going up. So that shifted burden back to them and away from non-homestead. And it got to a very low point to where they were almost the same. It's funny when you talk about $55 billion as being insignificant, but now, you know, when you talk about property taxes and taxable value, you're talking about trillions of dollars. Then it starts to rise again as property values rise, and taking out the potential impact of this pandemic, it will probably be above where it was in a few years. Move on, please. There's only a few more that I'm going to go through pretty quickly. To try to level the playing field a little bit, the legislature came in and did a non-homestead assessment cap, which would not allow it to increase by more than 10%. It didn't apply to school taxes. So whereas the saver homes applied to your whole tax bill, the non-homestead cap applied to roughly 60% of the average bill. It didn't have portability, so a business that moved or relocated couldn't take it with them. The recapture provision applies, and so because it was a 10 mil cap and allowed it to grow that much, the recapture provision comes into play a lot, and that's why it hasn't really had that much of an effect. As you can see in the previous slide, the differential is still going up. The cap was supposed to be repealed, and that should be off this slide because it was reinstated by the voters. Moving on. So again, determine the taxable value. You have the just value, which is fair market, minus the assessment differential, which is any kind of save our homes or classified use. Like for example, agriculture land is assessed completely differently at a much lower value. And so this gives you the assessed value and basically what your property is worth for tax purposes. And then you take away any exemptions that apply, and that is the taxable value. To move on for the last few slides, I just want to go through quickly. And these are those exemptions. The biggest one, government property, which probably doesn't even need to be on here because government property is immune from taxation. But the big ones are the two homestead exemptions. First one on the first $25,000, the second one on another $25,000 over $50,000. So you're still going to pay tax on that second $25,000. But if your home is valued more than $50,000, you start getting more of the exemption. Those two together are almost $3 billion. You have exemptions based on the type of property, like institutional property, which is, nonprofits and scientific and educational, although there's a special exemption for educational property down the road. Hospitals and nursing homes are exempt. You have a $25,000 exemption for tangible personal property. And then there's a lot of exemptions for veterans and permanently and totally disabled veterans. There's also been a new one for the spouses of first responders who were killed or disabled in the line of duty. And then you also have some local option homestead exemptions for elderly, low income. And if you're over 65, meet the income requirements, and have been in your house for more than 25 years, you can get a total 100% exemption of your property taxes if your local government has adopted it. Move on. These are just a few more of the small ones. I'm not going to bother to go through them. One more, I think. Go on. And here's just a few more. There's the first responder one we talked about. Also, if they're if military personnel is actually deployed overseas, they get a break on their property taxes then. And legislature lately has been adding more operations to that. They list what military operations qualify, and they've had to keep adding more and more onto that. And then historic property, household goods, and inventory are very, very big. There's not really an estimate for those, but those are also things that aren't taxed. So, Dominic, I guess, is there anything else you want to cover? All I will say is it's real important for the press to keep people informed about that, because one thing that Save Our Homes did is it kind of insulated most of the voters from property tax increases, and we saw a large decrease in public involvement in the hearings after Save Our Homes. People, the only people that would go were, it's especially during the housing bubble, we had a lot of snowbirds would show up at these meetings, and the commissioners would say, what are you doing here? Businesses would complain, and so, but the actual voters, your citizens, homeowners weren't going to those meetings anymore, and I think that was one of the reasons why we saw such a rapid increase in local government spending back at that time. So
Kirk,
the work you do is very important. Thank you.
Yes. Kirk and Dominic, we have about, a little less than 10 minutes for a few questions. So I'd like to open it up to the folks on the session, and no need at this point to type your question in the chat. Feel free to unmute your line and ask a question or two if you have.
Unmute your mind too.
Yeah, that's what I said.
While we're waiting, I'd like to go over that slide number 24, determine taxable value. Just very quickly, you find out what the person's, either the person or the non-person, that'd be a property owner's market values of the property, then minus any exemption or differential, like Save Our Homes or widows or whatever. You find out what the assessed value is. Okay, it gives you the minus exemptions gives you the taxable value, and you apply the taxable value to the millage rate, and there you have your property taxes. So it's fair, and usually tax policy things are either fair or they're simple. It's hard to have them both fair and simple, because you're trying to make equitable distinctions for people in different circumstances. So Florida had one of the most equitable property tax systems in the country until Save Our Homes. Save Our Homes threw a big wrench in it, not only by putting a limit of up to 3%, it's been more like 1.5% to 2% a year, but it shifted the burden onto everybody else. And there's an old adage in tax policy that when you work to help Peter, when you rob from Peter to pay Paul, you can always count on Paul's support. And so what Kurt's pointed out, though, is probably one of the most dramatic effects that Save Our Homes has had, not just on shifting the burden, but really taking the voter. Years ago, everyone faced the same property tax increase or change, but all of a sudden, the voter, the residential homeowner, was getting, properties might have risen 25% or 30%, but they got to see the millage rate reduced a little bit because theirs didn't rise for taxable value because they were covered by this artificial Save Our Homes, and the millage rate reduced their property. So, for example, I'm a homeowner, and my homesteaded property I've owned since long before 1995 is very little bit more in total tax dollars than when I paid in 1995. It's unfair, it's foolish, stupid, but it is what it is. So, and that's what, I've had the property now 31 years, and I'm paying close to what I paid then. And But anyway, it's just a shift, and had some good effects, but the negative effects have been far more pervasive. But the more you know, as writers, reporters, will also be available if you have any private questions. Kurt Wenner is very, very generous in his time, and we're very happy to provide this information. Again, just a reminder, we're 501c3, nonpartisan nonprofit group, and the more you know, the more you report correctly, the better off all your readers and audience will be. Thank you, Jim.
Yes.
Karen and Sam.
Yes. Thank you, Dominic and Kurt. And want to give another shout out to our sponsors, Blue Toad, Preferred Marketing Solutions, and Intersect Media. Hope you found value in our session this afternoon. And we always look forward to hearing from our members. So please send any suggestions for future VIP roundtables to Karen or myself. Our next VIP roundtable is being held this coming Thursday. Its focus is on using data to grow revenue. There's a session being held at 11 a.m. for the weeklies and 2 p.m. for our dailies. Hope to see everybody there. Have a great rest of the day and be safe, be well. Thank you.
Thank you.
Thank you, Dominic. Thanks, Kurt.
All right.
Thank you all very much. Appreciate the audience.
Thanks for your time, Dominic,
you.
Kurt.